Stocks taking a heavy beating today, but is there any bright side going forward, or any stocks out there impervious to what's going on in China and the downdraft in Asia? Joining me now, Steve Cortez. He's BGC Partners trader and senior strategist. And back with me, Dan Schaefer and Hillary Kramer. Dan, what are you looking at? What stocks could be impervious to the slowdown in China?
I would be buying stocks that are not in the Dow or the S&P. I'd be looking for domestic United States companies that are not affected by the U.S. dollar. That's what I would be buying.
Go ahead, Hillary.
Okay. You want to be domestic, beaten down stocks that have value and that are kind of immune to anything that may happen to the consumer. Dillard's DDS is at rock bottom price in comparison to its competitors. Right. Kohl's, KSS, you want to be there. Even Macy's, M makes sense, but you don't want to be up a level in luxury. You definitely don't want to be by Tiffany's or Michael Kors. Well, because Tiffany's and Michael Kors have the diversity globally in terms of buyers, and we are a mentality in this country where we'll still spend a little. We like a little luxury. The same with some of the restaurants.
I hear what you're saying. Steve, you know what's really interesting is that Home Depot raised its outlook twice this year, and Home Depot was not in correction territory. So is there some light here? Is there some chance to make some green with some of these stocks?
You know, Elizabeth, I think there are pockets of opportunity, and you mentioned Home Depot. Housing has done very well. One of the reasons, though, that housing is doing so well is that interest rates are staying extremely low. But by the way, that's only because global growth is so pathetic. So I don't want to get too excited about that. Is it good for that particular company? Probably. But is it good for overall growth? No. So I'm on the whole long-term very pessimistic. But are there some opportunities? I think so. When I look at staples, if there's a group that benefits from the commodity plunge, it's consumer staples, the processors of food, those kinds of companies that are represented in the XLP ETF. That had a massive range on the day. It tested its October 2014 lows down at 44, then it closed very well in the day. So I think in terms of being defensive, and I think defensive, domestic, dividends, stick to the D's here.
Interesting.
That's where you want to be.
You know, to Steve's points, Dan, his point here, you know, we're going to probably get a 3.2% read on second quarter GDP come Thursday. That's pretty okay in this market.
Well, no, I mean, the market's got pressure. There was a tremendous amount of damage that was done today in this market. I mean, Steve, you could jump into some of these stocks. I don't disagree with you. But for the average investor, you know, I think there's going to be a better opportunity buying in early September for a rally after this is over, because...
So you're not buying now?
No, I'm not buying now. I think we're going to have another dip on Friday, and I think that we're going to see a buying opportunity first, second week of September, and a rally into October 1st, and then boom.
Go ahead, Steve.
Dan, I don't disagree with you, by the way. I really believe that this is a calamitous situation. I happen to think that the Fed is not, no way are they raising in September. So I think the Fed and I think the People's Bank of China is probably going to send a lifeline to this market to lift it near term. But if I'm right about that, that is your chance to hit the sell button until your
Hillary,
finger bleeds.
So the market capitulates and the Fed capitulates. The Fed's not going to raise rates.
I actually think this is a buying opportunity here, and the Fed is not. There's no way rates are going to rise here.
No. Okay, we're going to leave it right there.